Sarat Sethi is managing partner and portfolio manager at DCLA. He's also a CNBC contributor. Sarat, it's great to have you. Let's dive right in and, okay, we're going to start with buy Comcast, but more interestingly, which is our parent company, of course, there's a huge amount of consternation between the broadband and the telecom space right now. Tell us what that's about and why you think Comcast is a buy.
So, good question, Kelly. A few weeks ago when I was on, it was one of my buy stocks, and the stock was trading close to 60 at that point. You really had two multiples turned down. It's trading at 14 times earnings. And really what's happened is the sell side has talked about the competition coming from the telcos and how that's going to actually bring down margins and disrupt the growth rate. We don't think that's going to really happen. I mean, the telcos have enough going on, and we'll talk about that on the sell that side. But Comcast really is a leader in its space. And if you look at the business, the margins just on broadband, and then you've got NBC Universal, you've got the international assets in the UK, Peacock that is basically valued at zero. And then you've got, if you look at the catalyst for November, when we're actually going to let people from Europe fly in and the borders are starting to open. So at 14 times earning, Brian Roberts at the helm, you've got a great balance sheet, 2% dividend yield. The downside here is much less than the upside. I mean, the upside for us when we see this stock is much greater. Do you want to quantify that, or? I mean, for me, I mean, you get a normal, so the S&P trades at 20 times, and this should trade at a higher multiple because the growth rate is higher than the S&P. So I could see, a 50% higher here. I don't know if it gets there in the next 2 to 3 quarters. We invest for 2 to 3 years, but this is a very solid company and they can buy back shares. They can take more debt on. The balance sheet is a very strong place. So fundamentally, I think this is, one of our best investments. All right. So on the flip side is AT&T, which we just got, we watch the stock, we see it at 11-year lows and wonder if a lot of bad news is already priced in. Why do you still think it's a sell? So we had actually owned it in the past, and once they announced the Warner Discovery deal, really what you're left with is a telco company that has to spend a lot of money on 5G rollout. The short-term issue is iPhones, but longer-term that'll get resolved. And then it's got a balance sheet that's highly indebted, and they're going to cut their dividend. What happens then when you cut your dividend is you get a shifting of your investor base as well. So a lower dividend, lower growth rate, much higher competition in the telco space with 5G, bigger spend, and really so where you're looking at kind of a depleting asset in our world and really not a company that I think is going to be growing in terms of multiples or earnings.
Hey, Sarat, this is Frank Holland here. Turning to industrials, you actually have a name that's in the news today, FedEx, one of the companies there at that White House meeting about the Port of L.A., and you actually have it as a sell, another company called TransDigm as a buy. Let's start with FedEx. Why a sell?
So if you look at FedEx, and one of the things that's happening is, we like companies that can raise prices as faster than costs are going up. Cost inflation for FedEx is so high in terms of wages right now, they just can't pass those on to their end consumers. The other thing is FedEx is just having a very hard time with logistics. They can't even have enough people at their facilities all over the country, all over the world. Oil prices also going up. They can't pass that through. So you've got a few things going on in a company that's extremely highly capital intensive, can't pass its pricing on, and then also, in terms of costs just going up at that time.
Shepard Smith here. Thanks for watching CNBC on YouTube.